Powell resigning will make housing affordability even worse than it is today, and we are already at record highs. And if you think that interest rates are coming down, you better buckle up because that couldn't be further than the truth. Let's dig into why the administration's trying to get Powell to resign, why that won't work, and why that wouldn't even make interest rates go lower in the first place and actually would push them higher. So, look, at the end of the day, Powell resigning will make the housing situation, the housing bubble that we're in, even worse. And we all know that we're about 30 to 40% overvalued, especially here in the Sun Belt. You can't underwrite any properties that even freaking cash flow unless the interest rate is bought all the way down to 3 to 4%. And even then, it barely makes any sense. So the reality is that Bill Pulte from FHFA, he was appointed to this position. He's one of the 25 grandchildren from Pulte Homes, has been slamming Powell on social media for the last few weeks. He says, "I'm encouraged by reports that Jerome Powell is considering resigning. I think this will be the right decision for America and the economy will boom." This is just a rich kid that has no idea how economics actually work. And it, frankly, both Donald Trump and Pulte calling for this is ironic because Trump was the one who appointed Powell in the first place. The reality is when you lower short-term interest rates, it'll increase inflation, it'll increase the yield curve, it'll make it more steep, and it will increase mortgage rates because the short-term interest rate does not mean 30-year fixed mortgage rates at all. And so there's a complete disconnect. And then secondly, if they do remove Powell, will it actually have any real impact on the voting mechanism from the Federal Open Market Committee, the FOMC? So every president would generally cut rates if they had the chance to because they need to stay in power and they need to continue to drive the markets and the economy higher and higher. So this is the reality for the Federal Reserve. It's supposed to be independent and it's not supposed to be manipulated by the president or anybody in power. The Federal Reserve was designed to be independent from direct political control to enable it to make sound monetary decisions without short-term political interference. Obviously, that's what we're getting today, and it's completely wrong, and it's sad that this is the way the country is going. This independence is crucial for maintaining economic stability and avoiding the temptation for politicians to prioritize short-term gains over long-term economic health. It's very well put, and unfortunately, there is a lot of political pressure there, but they probably won't be able to get him out of his $2.5 million renovation for the Fed, and he's actually inviting investigations into this budget that he has for the Fed and what they're doing in those renovations for the Federal Reserve. But how does the Federal Reserve work? Why does it work this way? So that's actually part of the Federal Open Markets Committee. There's 12 voting members. So even if they got rid of Powell, that does not mean that they can get rid of the rest of the people who are serving on these Federal Reserve Open Market Committee. There's a majority vote that has to take place. So there's 7 votes on the Board of Governors. These are permanent positions. They are appointed by the president and confirmed by the Senate. The next one that comes up is in May of next year. That's when President Trump will be able to appoint a new Fed chair because Powell's rotation will be out. And then there's the New York Fed president. There's always gets one vote, and that's permanent. And then there's 4 other regional Fed presidents that get to vote. Well, guess how they voted on the last one? 7 of the 12 said that they didn't see any rate cuts needed this year. 2 of them said, well, I think we need a rate cut right now, potentially. And then there were 3 of them that said, I'm not sure, I need to be data dependent. So there's already a majority saying we don't see any rate cuts. Changing Jerome Powell is not going to change the rest of the people on these Federal Reserve boards. Sure, you can have influence as the chair, but that's not going to drive everybody else's votes. So even if you got rid of him, there's no chance that they're going to be able to cut interest rates on the federal funds rate by 300 basis points, which is what Trump is calling for. So what does the Fed do? It sets U.S. monetary policy, interest rates, quantitative easing, and quantitative tightening. They basically manipulate the monetary supply and the overnight borrowing rate to influence the direction of the economy. They meet 8 times per year. Again, the decisions are made by majority vote, and the Fed chair is the most influential, but does not unilaterally decide the policy on how they're going to move forward, okay? So their mandate is 2 things. This is really important to understand. Keep inflation low and stable generally targeting 2.2%. It's obviously inflation is higher than 2% right now when you're looking at core inflation, and they want to prevent runaway inflation or deflation. Maximum employment, promote conditions that achieve the highest level of sustainable employment. Well, we have around a 4.2% unemployment rate. That's pretty low, not a specific unemployment rate, but a labor market close to full employment. So they want to have price stability and maximum employment. And frankly, you can already see that the stock market's at record highs, Bitcoin's at record highs, the real estate prices in most areas are near record highs or at record highs. And there's no economic reason to drop interest rates at this point and blow these bubbles up even bigger and make it more unaffordable for the average American to be able to purchase a property. So here's the yield curve. What the yield curve is basically over the next 30 years, this is the rate that it costs the United States to borrow based on the longevity of the bonds that they're issuing. So you can see over the 30-year rate is high. So this is a steepening yield curve. And on the short term, we have a little bit high rates, probably because of a lot of what's going on with the budget and the budget deficit. But you can basically lend to the US government and get a 4.5% interest rate, which is actually phenomenal. And then when you get out here to the 10-year and the 30-year, we start to see this steepening. That's because of expectations of inflation over the long run. And basically the yield curve is an expectation of inflation over a long period of time. And this is investors placing their bet during those time periods. And ultimately, we're getting paid a premium right now because there's a lot of uncertainty with the budget situation and the big, beautiful bill that just passed. Even though we have the tariff revenue come in, it's not what you might think it is. And we can jump into why that actually influences the long-term yield curve to move up. And what you need to understand is that mortgage rates are based on the 10-year Treasury because that's the average duration that somebody stays in their house. Even though it's a 30-year mortgage, people only stay in their house about 10 years. And that is why the 30-year mortgage rate is usually trades very similarly to the 10-year Treasury bill. All right. So here's the chart that shows that the 30-year fixed mortgage is tied to the 10-year Treasury. Everywhere they go, they're pretty much in lockstep. You can see they kind of disconnected a few points in time, but for the majority of it, they are really they go in lockstep every single month. And work together. There have been a little bit of a decoupling between the 30-year fixed and the 10-year Treasury, and that's because there's less demand for mortgage-backed securities than there are for Treasuries. But the yields have basically come up pretty drastically as we saw the Fed hike their interest rates on the short part of the curve, and then it's flattened out and has basically been range bound for the last few years around the 6 to 7% interest rate mark. Now, here's core inflation. When the Fed raised rates, obviously core inflation came down, and we're now at 2.8% core inflation, which is above the inflation target for the Federal Reserve. So again, not another reason to cut rates right now. There's no economic reason to cut rates, and you don't want to cut rates too soon to cause inflation that is unnecessary and then have to increase rates later. And here's the biggest lie. This is really bad. I mean, look, when you see bragging out there that, hey, we brought in $100 billion worth of tax revenue through tariffs, this is what Goldman Sachs says. 70% of that is passed on to the United States consumer. That's what this chart tells us. So, and look at then there's only a certain percentage that are absorbed by U.S. businesses and foreign exporters. So, frankly, you're basically just bragging that you're providing more tax to consumers. And this is the big lie, right? They're trying to make it feel like something it's not and that we're fixing the budget through this, but it's just not the case. The only way that this would solve long term is if we onshored a lot of the manufacturing and made it cheaper locally and we're able to get prices down locally. But that takes years, and to build these manufacturers it would take a really long time. So we wouldn't be able to see the benefits of this in maybe ever. That's if we start manufacturing things here locally. Otherwise, the cost is just straight on 70% brought back to the consumer. So you can brag about it all you want, but it's not great for the U.S. consumer in this regards. But why cut rates? Why create more asset bubbles? The stock market is a record high. Bitcoin's at record highs. Real estate market's near record highs. And employment is okay. Maybe Trump wants to use the lower rates as a bargaining chip where he can go out there and really negotiate these tariff rates. But that's not the point of the Federal Reserve. That's not their mandate, is to worry about tax revenue through tariffs. They have two mandates: inflation and stable employment. So look, housing payments are already crazy at record highs. If we cut short-term rates, it could push the mortgage rates higher because of more inflation down the line. People expect prices to be higher in the future, and that could cause this to just continue to get out of control and have an affordability crisis. We are already seeing 68% of Americans basically live paycheck to paycheck. There's a stat out there that 47% of people die with no assets at all. I mean, we are in an absolute bubble where the majority of gains that would come from a rate decrease would just go back right to the top 1%, inflating their assets while the middle class gets hollowed out. This is not good for America. Going after an independent Fed through the presidency is not good for America in a time period where we need stability. And frankly, why push asset bubbles even bigger at this point in time? We all know that the valuations of the stock market and real estate market are just completely, disconnected from what's happening on Main Street, and it's being pushed higher just by a handful of AI stocks. It just really doesn't make sense why they're making this move. I think Pulte's doing it because he believes that reducing the short-term interest rates would bring down the long-term rates, and that would help him out and his family's businesses out on the mortgage side and on the housing side. But that's just not how it plays out in economics. It's going to depend on how investors respond to those lower rates, especially if we don't see, issues with employment. And now we just created more and more of a bubble because frankly, everything in real estate is a function of payment. So if mortgage rates continue to move up because of this move, then home prices will come down. And that's what we need. We need home prices actually to come down long term, but it makes more sense to just keep rates here, be data dependent. And I think the Federal Reserve, contrary to what most are saying on the news, they're doing the right thing. They are sticking to their mandate despite political pressure. Powell seems like the only adult in the room making these decisions. And a lot of people are going to disagree with me. So comment, do you think that Powell is the adult in the room or he needs to be removed? I'd love to hear your reasoning and rationale behind that. But I can tell you this, lower rates is going to cause inflation and we don't need more inflation. Prices are already very, very sticky and not coming down from these elevated levels that we had during the 2020 to 2022 time period. So here's Homebuilder traffic again. He's trying to find any way to drive his family business moving forward. You can see in 2025, home builder traffic is down because of these high interest rates. The only other way that the Fed can come in and lower interest rates directly would be going into the FOMC and buying mortgage-backed securities. But they already own $2 trillion of mortgage-backed securities that are still on their balance sheet and rolling off every single month. It wouldn't be a good move for the United States to continue to build up its balance sheet and put more money out there into the economy and cause and drive inflation. So here's my hypothesis. Mortgage rates will go higher if they cut the short-term rates. Prices will get a short-term jump in housing, but then the affordability crisis will absolutely crush because who will be the buyers who will be able to purchase? And we'll see a bubble extend and then pop in the Sunbelt area specifically. These areas in the South where the builders overbuilt, they expected all this population growth and we're not seeing it, and a lot of migration, we're not seeing it. And now we have this massive supply that is completely unaffordable, and it'll take time for these assets to come down. It doesn't happen overnight like the stock market. It can happen, within 2 to 3 to 4 years. And combine this with the massive amount of spending from the big, beautiful bill. We just see inflation going higher for longer. We see inflation from the tariffs, and cutting rates right now, I think would be a combo punch to basically raise interest rates, mortgage interest rates long term because of the fear of inflation expectations on that yield curve. What do you think? I want to know what you guys think. Can we outgrow the compounding deficit issues? That's another thing that they're looking at. But at some point, you have to come to the realization that you have to let the market correct without interference from the Federal Reserve. And we've been manipulated for a very long time on all these housing prices. And this is, again, another kind of boom bust type of cycle that we're seeing here in the South. And I personally believe that we cannot outgrow the compounding deficit issues. I know that Scott Bessent said that there will be growth without inflation, which is something hilarious to hear because that does not happen. And lowering interest rates will not cause there to not be inflation. Of course, there'll be more inflation. It spurs demand, more demand chasing the same number of goods. But let me know what you think in the comments. What do you think the Federal Reserve should do at this point? Should they stay on their current path, being the mature adult in the room? Should Jerome Powell, is he cutting too late? because he has fear of future projections, right? That's a lot of his criticism. He's been looking backwards the entire time. Now he's looking forward to these tariffs and, including those in his calculations. What do you think? Is he on the right path or not? So happy to answer any questions. Again, subscribe to my Substack. I talk about things there I cannot talk on YouTube. The information is down below. Love you guys. Thanks for watching and can't wait to hear what you think. See you later.